Back to it. So I've got the balance amount here. Next date I'm looking for is the 3rd of August. And we do a purchase. So when we purchase, items are coming into the business. So we're purchasing 541 units at $6 each. So we're going to put 541 at $6. Multiplied by 6. So the next line, might just put a line underneath that just so it helps us break this up, because you do need them for this one. So what we have now in stock, we've got the $7 batch right here. We have them in stock. That's our old one, it sits on the top. The new stuff comes in and we put it underneath there. We'll get rid of that line that appeared there. Alright, let's get rid of that line. So now at the top here, we have $7 lot and a $6 lot. If we're going to sell stuff, which will be the next one, we're going to get rid of this stuff first, then get rid of the new stuff. Then the new stuff. If you get an amount in that costs the same amount, so if I purchase small $7 lots in, or more, I could have a quantity of the $7, I need to, I still need to separate them. Okay, so it's better to have that blanket rule to separate everything. Okay, 7 of the 8th. We're going to do a sale. It's got here. Okay, shh. Fellas, I hope it's about this up here. So next up, we're going to have going out in the sale, so 500 units. We don't have 500, so first lot we've got to sell is the $7 here. We don't have 500 of those, so we've got to make up that 500 with some of the $6 lot coming out of here. So first off, we're going to sell all this. Get rid of all that. 425, $6, and it should equal whatever that meant to. We've got to make up the difference, so number 75 will make that to the 500. Oops, that should be the $6, sorry. And that's the 6. Now you would have charged the customer the same price for it all. It's just our profit margin will be different for the items that we're selling. But the customer, because they would have said, well, why, that's silly. So they would have charged them the same price for all 500, but that's our cost price it cost us. So our new balance of the $6 there we have now, because we've got no more $7 items, we've only got the $6 items. So it'll be 541, subtract 75 is 466. Okay, so that's the new value of our stock that we have, $2,796. Okay, next up, 10th of August. We're going to do a purchase. We're going to purchase at $5. So we've got more items coming in. This time they cost us $5. So, first off, when we do up the balance over here on the end, units on hand, we've got to account for this amount. Some decimals there. Just get rid of that colour. Okay, $6 amount there. Okay, and then that goes on the top. The old stock, the new stock that's just come in goes underneath, slots underneath it. Oops, I didn't want to do that. Oh, I don't know why it's uncoloured, but it's alright. So you can see the old stock on the top, new stock is there. Okay, the 14th of the 8th. So you can see a pattern happening here, hopefully. Okay, a sale. So I'm coming out of the business again, this time 650. So we have to get rid of the $6 amount first. Then we get, and if we need to dip into the newer stock and get that out. So 650 we need to make up. So it's only 466. We don't have the full lot there of this, so we have to sell all that. And we make up the difference to 650, so take a bit out of this here, the $5 amount. Oops. 650 subtract that. It's 184. Okay, at $5. So what we are left with is 440. So 2,200. So next we're at the 25th of August and the 29th of August. We're going to do some purchases. And we're going to purchase 750 at $7 each. Should equal 5,200. So this new stock slots straight under. Last one, the 29th, we do a sale. And with stocks going out when we do a sale, so it'll be 500 being sold. Well, it's not 500. So we've only got 440 of the old one, so we have to sell all that. first. Should equal, and then the remaining 60 to make the 500, sell $7. So next up, we do a stock take on the 31st of August, and 650 units in stock. That's how much the net of GST. That's good because we don't feel like calculating that. So there's no GST in this one here. So we need to, well, it's not going to do with it, 650 are left in stock. We've got 690. So they've counted the shelf or wherever the item is, and they said, oh look, there's only 650 here, not 690. So our records are wrong. It's easier to adjust the records than try to magically make another 40 appear. So we need to make a change. So 31st of August, and we're going to put here in inventory adjustment. Okay, I was going to say stock take, but it's not. So we have to think about, so we need to have the final figure say 650, the balance there. Okay, it's going to be for the $7 amount, whatever the oldest stock is, not the newest stock, the oldest stock. I don't think we do this in this question. We don't. We don't, it's all right. So that's what the balance should be. This is what it should be equaling. So we need to make the adjustment here to get it down to 40. So we're going to have some leaving our store. So it'd be 690 minus 650 should equal 40. And we're going to $7, use that amount, that cost price. So we're going to see a decrease by $280. It's going to decrease our stock buy. So we need to put a journal entry into that to record that in our records as well. So this is the stock card, which gets recorded. Now we need to put this into the records. The general journal of the business. So 31st of August. All right, so there's going to be 2 accounts involved. All right. First account's going to be a new one. We introduce you to inventory adjustment. Okay. So the inventory adjustment account is an account, it's an expense account, or it can be a revenue account. So if we've got a surplus, that means we've got more, it'll be a revenue account. So if we debit the account, it's going to be an expense, or it can be a revenue account if we found we've got too much in there. So this can alternate between expense and revenue. It's a magic account and change. So this will be an inventory adjustment. We're going to debit this account. It'll be an expense. The other account we need to adjust is obviously the inventory. It needs to be adjusted. Okay. So adjustment we need to bring down the inventory account. Okay, and that's going to be credited because it's an asset. When you decrease an asset, it's going to be credit. So it'll be for at $280. The amount that we're decreasing it by. I've seen students in the past mistakenly take these figures. They're the total of what we have. This is just how much is being decreased by the ledger account. Debit equals your credit. Okay, and so I do a lot of typos because I don't do touch typing. Adjustment of adjustment for shortage or inventory shortage. Okay, that's it. So that's a recorded one. That's how you record inventory in there. First in, first out. Okay. Shh. So you can see a slight difference there to the weighted average, which mixes it all together, all the cost prices together. So remember, these are cost prices, not selling prices. Okay, so our profit margin will differ depending on the item. You would sell the customer generally the same price, depending on what it is first. So that's one of the questions there. Okay. The next one I'll have you do.